Imagine this. You take out a 20-year loan to buy a luxury car, but plan to pay it off by giving neighbors small ride shares, which they pay for week by week. It sounds insane, doesn't it? You have long-term debt backed by short-term volatile revenue. Well, that was essentially WeWork's financial model. For a few dizzying years, this company, which was nothing more than a glorified corporate landlord renting out desks, somehow convinced the world's sharpest investors that it was a revolutionary tech giant worth $47 billion. Let that number sink in. $47 billion. At its peak, WeWork was valued higher than giants like Ford and General Motors combined. But this wasn't the price of a business, it was the price of a dream sold by one man. Adam Neumann, a towering, charismatic Israeli entrepreneur. He spoke not in terms of profits or margins, but of changing and elevating the world's consciousness and creating a beautiful life for all. He didn't just rent desks, he sold a global community. And SoftBank, the Japanese investment giant, bought into it completely. They poured over $18 billion into this vision. This is the story of Adam Neumann, the prophet of the party. This is the story of the $47 billion crash. The moment the financial world learned the hard way that there's a huge difference between a good story and a good business. It is the most spectacular and absurd crash in modern financial history. The story of WeWork begins in 2010 in New York City. Co-founders Adam Neumann and Miguel McKelvey wanted to solve a simple problem. Traditional office spaces were rigid and dull. Their vision was to create a space for the modern freelancer, a place offering free beer, ping-pong tables, sleek design, and a genuine sense of belonging. The concept was simple. WeWork signed long-term leases, often 15 to 20 years, with building owners, subdividing the space into smaller offices and desks, which they then rented out on flexible, short-term membership contracts. On the surface, it worked. The offices were cool, the beer was free, the community was genuine. By 2019, WeWork had become the largest private occupier of office space in cities such as Manhattan and London. However, the company's success was not based on revenue, but on narrative. Neumann was a master storyteller. He didn't want WeWork to be seen as a real estate company. He insisted it was a tech company, a critical distinction when it came to attracting venture capital. Tech companies receive high valuations because they are expected to grow exponentially without significant overheads. In contrast, real estate companies receive low valuations because they are bound by physical assets and leases. Neumann relentlessly promoted the tech narrative. This narrative found its perfect enabler in Masayoshi Son, the CEO of SoftBank and the architect of the $100 billion Vision Fund. Son is famously driven by the vision and a singular mantra: go big or go home. When Son met Neumann, it was a meeting of two ecstatic visionaries. Neumann showed Son his numbers, but Son said they weren't big enough. Son's checkbook was the ultimate accelerant. SoftBank's investments totaling over $18 billion allowed WeWork to grow at an unprecedented rate, burning through billions of dollars annually. When a company is told by its main investor to prioritize growth over profits, it can lead to unprecedented corporate excess. However, the financial model was fundamentally flawed. Imagine a bank that takes out 15-year mortgages, long-term leases, and funds them by borrowing money that must be repaid in 6 months, short-term memberships. If the economy hits a rough patch, the short-term members leave, but the 15-year lease payments remain locked in. WeWork was designed to thrive in a boom and collapse in a bust, and the excesses went far beyond the balance sheet. Neumann believed that he wasn't just running a company, but a movement. The company's name was changed to the We Company, encompassing We Live, residential, We Grow, private schools, and even Wave Garden, an investment in artificial wave technology. Neumann began treating the company's money as his own. He bought a $60 million private jet. He purchased properties and then leased them back to WeWork. One of the most notorious examples of self-dealing was when he trademarked the word "we" and then made the company pay him $5.9 million to use the trademark, an internal transaction which was later cancelled due to public outcry. The company culture was toxic too. There were mandatory all-hands meetings that devolved into tequila-fueled parties, mandatory veganism in the office, and a cult of personality centered on Adam. By the summer of 2019, WeWork was preparing for its initial public offering, IPO. This is where the story pivots from an internal party to a public execution. When the company filed its mandatory S-1 document with the SEC, the public finally got a look at the raw financial data, and the numbers were shocking. In 2018, WeWork lost $1.9 billion on $1.8 billion in revenue. They were losing more money than they were making, but worse than the losses were the corporate governance red flags buried in the document. The S-1 filing revealed bizarre metrics, including a new financial measure called community-adjusted EBITDA, which was seen as a joke by the financial community. Essentially, it meant earnings before all the bad stuff. Investors took note of the self-dealing, the bizarre investments, and the structure that gave Neumann 20-to-1 voting power, effectively making him untouchable. The question the market asked was simple. What is the difference between WeWork and a conventional real estate company? The answer was nothing, except the hype and the debt. Wall Street rejected this premise. Fund managers didn't want a profit. They wanted someone who could be relied upon. The initial IPO valuation was expected to be $47 billion, but analysts quickly slashed this to $20 billion, then $15 billion, and eventually to below $10 billion. The IPO was officially withdrawn in September 2019. The market had spoken. The story was over. The collapse was instant and brutal. Within weeks, Adam Neumann was forced out as CEO. SoftBank's Masayoshi Son, the biggest corporate villain in this story, had to step in and orchestrate a bailout to prevent the entire company from failing and wiping out over $40 billion of paper valuation. The bitter irony. Adam Neumann, the man who had almost bankrupted the company through spectacular mismanagement, walked away a billionaire. He received a golden parachute of almost $1.7 billion for selling his shares and stepping down. SoftBank, the primary enabler of Neumann's vision, became the majority owner and was forced to manage a mundane real estate company that it never wanted. The WeWork saga is the definitive lesson in the post-dot-com era. It proves that valuation is only a feeling. When the music stops, cash flow and the underlying business fundamentals are the only things that matter. It shows how massive capital can be raised and burned by a charismatic visionary who convinces investors that his company is going to change the world, even when all they are doing is subleasing desks. The failure of WeWork was not a tragedy. It was a predictable accident. And the final question is, will the investment world ever learn the difference between a great party and a sustainable business model? History suggests the answer is a resounding no.